I want to start with your background because you've worked at Bain Capital, you've worked at Bridgewater, you're a graduate of Harvard, you've been in the industry. What led you to studying private equity and, frankly, this piece that a lot of people think would be somewhat a takedown of the premise of private equity?
Yeah, well, I think there are really three things that people need to understand about private equity today. The first is that there's an overwhelming consensus among institutional investors about private equity, that it's basically the holy grail of investing. A recent Preqin survey suggested that 50% of institutional investors believe that private equity will outperform by 4% per year. Another 45% think it will outperform by 2% per year. The second thing you need to understand is that those expectations are wildly off. Private equity has not outperformed the public equity market since 2010. In fact, on a 1-year, 3-year, and 5-year basis, according to Cambridge Associates data, private equity has underperformed by 4%, 2%, and 1%. And the third thing you need to understand is that that institutional consensus that private equity is going to outperform the public equity market is what's driving purchase prices higher and what's driving returns down. And so having studied this for 7 years, I felt it was important to write and to say these expectations are crazy. Private equity will not deliver those returns. It has not been delivering those returns. Okay. And public equity investors need to look elsewhere. So,
Dan, what would you say to private equity managers who say, look, we go in, we help manage the companies, we make sure that they do the right thing, and therefore we provide alpha that's independent of the market cycle?
Well, first of all, they have not provided alpha over the past 3 years, 5 years, or 1 year. And in fact, the 2015 private equity vintage has underperformed the public equity market by 5% per year. So there's not a lot of evidence right now that they have generated alpha in the post-crisis era. In fact, operational improvements, which is the big claim of alpha drivers, if you look at what private equity firms do when they buy companies, there's no big systematic change in operational metrics. What you do see is a significant increase in leverage. And I think that too many folks have confused leverage for genius.
Daniel, how do you quantify the level of systematic change within companies and then determine that there hasn't been very much?
So I looked at every company. There were about 390 private equity deals that issued public debt as part of their financing, which meant that they were able to, they had to provide financials both pre and post acquisition. So I looked at how did the financials change? What was the difference pre and post? And what you saw is that revenue growth slowed, EBITDA growth slowed, CapEx spending went down as a percentage of sales, and leverage went way up, and interest payments went way up. And I think that makes logical sense, right? This is the leveraged buyout industry, not the operational wizard genius industry.
But if they use cash and debt to acquire and you see a boost to the internal rate of return here, the interest paid on the debt becomes a component of the EBITDA of the business. I guess they would push back and argue that point. But Daniel, we're talking quite generically at this stage. In particular, are there anomalies here? Are there private equity companies that actually are outperforming?
There certainly are. There are certainly firms that are doing a great job. And I think what those firms tend to have in common is that they're buying at significantly lower prices than the broader private equity market. So if you look at what's going on in terms of prices, private equity average purchase multiples hit 9.5 times EBITDA at the height of the pre-crisis boom in 07. They came back to 9.5 by 2014, and we're now up to 11 times EBITDA. And at those valuations, 15% higher than firms were paying in 07, and they didn't really beat the market by very much in the 07 year vintage. Private equity firms, it's almost impossible to make money buying at those valuations. Now, there are firms that can find much cheaper deals or have great price discipline, but those are few and far between.
Daniel, can you name and shame? Who are the underperformers here and who are the outperformers in terms of private equity firms?
You know, in terms of price discipline, I think that two of the standouts really are Apollo and Oaktree, who are the folks that are really buying things cheap. And I think broadly, you know, almost anyone else in the industry is buying expensive, although there are other exceptions.
All right, so what have your colleagues, your former colleagues at Bain Capital, what have they said to you about this article?
I think that a lot of folks in private equity know that these things are true. They know it's a much more difficult environment. If you look at what the CEO of Blackstone or Apollo or Carlyle are saying in their press conferences and their public statements, they all agree that valuations are very high.
Yeah.
It's a difficult deal environment.
All right.
And simultaneously, they're raising more and more money.
So what do you think that investors should do with their new dollars instead of private equity?
Good question.
So I think if you want to make private equity returns, you have to do what the private equity firms did when they made those returns, which is to buy small companies at cheap valuations and use leverage to do that. And I think there are great opportunities in the public equity market to buy leveraged small value equities and get returns that look like 1980s or 90s LBO. But it's not going to happen in private equity.